Mindsetters. We are here today. It's a nice Monday day, and I'm here with my friend Martin. How are you?
Hi, I'm very well, thank you. How are you doing?
Fantastic. Before anything else, before I tell you what's happening, I just want to tell you that the show is proudly sponsored by the MTN SA Foundation and endorsed by the Department of Basic Education. I always get that mixed up. Sorry. But I also just want to tell you we're doing accounting today, and I just want to give a shout out to my main man Blakey, and also to everyone there at Mill Park Radiology Incorporated. Just hello, because I know they're watching at the moment. And I'm going to tell you where to find everything. Do you want to say something about accounting before I get into everything I need to say?
Well, I just want to say welcome to the grade 10s today, and we're going to do some important accounting, some financial statements and adjustments.
Awesome, Martin. Thank you. So where to find us is facebook.com/learn extra with an X. And I just want to tell you grade 11s about our awesome Be a Bright Spark competition with the K53. So as you all know, you were supposed to have entered the competition, and there's talk about a Chevy Spark and what. So what I'm going to tell you is the finer details, and this is especially important, so listen up. So if you have entered the Be a Bright Spark competition to win a Chevrolet Spark L, all you have to do is keep your eyes peeled on our show on Sunday, the 23rd of November this year, 2014, where the winner will be announced. And it could be one of you Mindsetters. So keep your eyes peeled, please, 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 please. And if you don't win the first time round, don't worry, there's still another 3 draws. So please, guys, keep your eyes peeled this Sunday, and we'll be hopefully saying your name on Sunday. So enough about this and enough about the competition. And if you want to check me out, it will also be at Learn Extra to find out more information about the show. So grade 10s, let's get started, and all over to you, Martin.
Thank you very much. And grade 10s, welcome. What we're going to do today is a very important topic, which we call financial statements. And at the end of year, we've got various adjustments that we need to do. So this is a section that I'm sure most of you have started in your last term or even in the third term, and it's something that's very important for your final exams, because at the end of the year we prepare 2 financial statements. We prepare an income statement and we prepare a balance sheet, and then we do these adjustments at the end of the financial year to make sure that the figures that appear in our 2 financial statements are completely accurate. So what are we going to go through today? Well, first of all, our focus is mainly going to be on the balance sheet. Now, you know that in grade 10, you really focus on a sole trader, and we're going to discuss the balance sheet and its notes if you're doing the books of a sole trader. Also, we need to understand the need for adjustments at the end of the financial year. Basically, what we're doing when we're doing adjustments, we're trying to ensure that the figures in our balance sheet and in our income statement accurately reflect the income that we've earned in the financial year, and that the balance sheet accurately reflects the financial position of the business on year end. So let's take a look at our challenge question first of all. Okay, so this is really a question in format. What I want to know is, first of all, to tell me what is the difference between a current asset and a non-current asset. Try and give me a definition of those two, explain what the difference is between the two. Then tell me what is the difference between a current liability and a non-current liability. You need to know these things. They're very important theory, because you need to know which items go under current assets and current liabilities, and which items go under non-current assets and non-current liabilities. Then finally, you know that there are various notes to the balance sheet, and I want to ask you about specifically note 7. I've created a little table for you where I want you to reconstruct the items that go into note 7, reconstruct it and tell me what goes into note 7 in the space below. I'll give you a clue. That is the owner's equity note, and if you've got any idea of how to reconstruct it, please send us the answer on Facebook so that we can give you a shout out if you get the answer right. And then there's another little question here. I just want to ask you, if I've got a bank overdraft, you know that bank can be positive or it can be negative. Either I've got a positive amount of money in the bank account, or I've got an overdraft. Please tell me where in the financial statements I'm going to find a bank overdraft. So those are the 3 separate parts to your challenge question today. Try and get those answers in, see how many of you can get the answer right. I'm sure that won't be any problem for you. Okay, so now let's look at the summary of the key concepts that you need to know today. We know that a company has got an end of a financial year. Any business, whether it's a company, a sole trader, or a partnership, has got an end of the financial year. And what we do at the end of the financial year is we prepare two different financial statements. Financial statements are very important because they give you an idea of how the business is doing. So the two statements that we prepared, number one is the income statement, and what that really does, it's used to calculate our net profit for the year. Any business wants to know whether it's as profitable, whether it's making a profit, or whether it's making a loss. And what we're going to do is we're going to prepare an income statement in order to calculate whether we've made a profit or a loss. And in here, what we're going to do, mindsetters, is we're going to include all of our incomes and all of our expenses. Those are the two sets of accounts that go into your income statement. You can remember those as the nominal section of the general ledger. I'm sure you're all aware that the nominal section of the general ledger includes all of your incomes and all of your expenses. But our focus really today is going to be on the balance sheet. The balance sheet is also sometimes called the statement of financial position. Some textbooks will refer to it as the statement of financial position, and when you get to matric, you will probably have to call it the statement of financial position because the terminology is changing based on the new Companies Act that has recently come into effect. So what this really does, it's almost like a snapshot, like a photograph of what the business looks like today. And what it really does is it shows our famous accounting equation, assets equal owner's equity plus liabilities. So those are the items that are going to go in the balance sheet, and you should remember that only our assets, our liabilities, our capital, and our drawings go into the balance sheet. So you can remember that those four items, assets, liabilities, capital, and drawings, those are the items that you will find in the balance sheet section of the general ledger. So if you're ever confused, just make sure that you know that the items in the nominal section go into the income statement, and the items in the balance sheet section obviously are going to go into the balance sheet. So I've said this before, just to highlight it again, the balance sheet is like a snapshot. It shows us the accounting equation, and it shows us the assets, liabilities, and owner's equity in the business on a certain date. Remember that an income statement is done for a whole year or for a whole month, for whatever period you're doing your books in, whereas a balance sheet is done on a certain date. This is what the business is worth on that day. And it's vitally important for us to know where everything must go in the balance sheet. So my strong advice to you is that you learn these items very, very thoroughly. You need to know the notes to the balance sheet very thoroughly. And what I suggest you do when you do your exam revision, make sure you know what goes in each and every note, because you don't want to put the wrong things in the wrong note. That's one way to lose a lot of marks. Make sure you know all of the 8 different notes that go into the balance sheet, and we're just going to go through them very briefly. Remember, there is note 3, which is the note on fixed assets. That note is ready to be covered in grade 11. Some of your teachers may have taught you that note already. That's the note on fixed assets, but normally what we're going to do is we're going to cover that note in grade 11. But the other notes I've summarized over here. Firstly, by the way, there is a note 1 and a note 2. Note 1 is the note on interest income, and note 2 is the note on interest expenses. Those are notes to the income statement. They're not notes to the balance sheet, so I'm not really covering them today, but the ones that I am covering are the ones that you will find in the balance sheet. Very importantly, let's start with note 4. Note 4 is the note on inventory, and that's only got these 2 items in. It's got your trading stock and it's got your consumable stores on hand. This is a very important note. You will always use it when you do the adjustment involving a physical stock take. You know, you've often seen that adjustment before. The business does a physical stock take at the end of the year, and it counts its trading stock on hand, and it counts its consumable stores or its stationery or its packing material on hand. These are the items that go straight in here into note 4 on your inventory note. Okay, note 5 is very similar. Note 5 is your note on trade and other receivables. It's also a current asset, and this one includes your trade debtors, your accrued income, your prepaid expenses, and then sometimes, depending on the question, you might also have some other money that might be owed to you, such as debtors for insurance. If, for example, some trading stock has been damaged in a fire or in a theft, and the insurance is going to pay out some money or some value of the trading stock, we're going to have a debtor for insurance. Then we've got note 6, which is your note on cash and cash equivalents. This one's easy to remember because you're going to put in everything that is almost cash or is going to be cash next year or is cash already. So we've got here bank, we've got petty cash, we've got cash float, any savings account, and the current portion of a fixed deposit. In other words, a fixed deposit that's going to mature in the next financial year. You've got to understand that all of those items are going to go in cash and cash equivalents. I'm sure you've answered my challenge question already, but think again, where would bank go if it was in overdraft? Think about it. We'll answer the question later in the show. Now, if we go on to note 7 is the one that is in your challenge question. That's really the owner's equity note. If you've solved it already, that's great. Otherwise, think about what goes in your note 7 on owner's equity. And then finally, the last important note that you need for grade 10 is your note on trade and other payables, which is one of your current liabilities. In here, and please note the format carefully, you're going to put your creditors, you're going to put all your income received in advance, you're going to put any accrued expenses, and then you're going to put these 4 or 5 items that are involved in your salaries journal or your wages journal. You'll have your creditors for salaries, your SARS PAYE, any money owing to the UIF, any money owing to the medical aid fund, or any money owing to the pension fund. And then finally, just like we did with our fixed deposit that is going to become cash in the near future, any loan that is going to be repaid within the next 12 months is called the current portion of the loan, and that is also shown under trade and other payables. There's one item missing which is sometimes shown there. Think about what that could be, and I'll tell you just now what it is. Now, mindset is, I cannot overemphasize the importance of learning these notes very, very carefully. You've got to know, you must be able to understand immediately where we're going to put creditors control, where we're going to put debtors control. If somebody wakes you up in the middle of the night and asks you what goes in trade and other receivables, you must be able to state that. So learn this very, very well, because it can really help you in an accounting exam if you don't have to think about where every item goes. And the good news is that these notes don't really change in grade 11, and they also don't really change in grade 12. There are a few little differences, but if you master these notes and learn them almost off by heart in grade 10, your accounting life will be a joy in grade 11 and grade 12. So take my advice, learn these notes carefully. Okay, so let's look now at an example exam question. So this is from a previous IEB exemplar from 2006. And what we've got here is a business from Belly Buttons. Belly Buttons is a sole proprietor, and she is a business that sells homemade sweets and chocolates. Sounds like a business that I would want to buy from. And this accountant went on leave after completing the balance sheet for the year ending 31st of December 2006. So we've got a balance sheet, and the accountant has prepared this, but it says that we've got to complete the balance sheet after taking into account the information that follows. So this accountant went on leave, she didn't complete the balance sheet, and what you, as the grade 10 accounting student, have to do is fix the mistakes or take the adjustments into account, and what we've got is an example balance sheet over here. So interestingly here, this question is not actually asking you to complete the various notes to the balance sheet. What they're asking you to do is complete the adjustments to the balance sheet straight in this column. Looking at the non-current assets, there's a star here and a star in the inventories. There are various stars where you are required to fill in the missing information. Now, what I'd like you to do, before we go to a commercial break, have a look at the format of this balance sheet, and you'll see there are 3 stars here. There's a star underneath non-current assets where the description is missing. Try and figure out what that one is. Then there's another one under inventories. We've got current assets and we've got inventories, a star, and cash equivalents. See if you can fill that one in. And then at the bottom, we've got non-current liabilities. Tell us what that is. And under current liabilities, there's a star over there as well. See if you can figure out what the missing stars are during the break, and then we'll check your answers after the break. So I think it's about time for a break now. Am I right?
You are right. The time clock says 0:00. So, I know you're just overwhelmed with notes and what to study and ledgers and this, but I know you just have to go take a break and think about all of it. So we're going to give you that little bit of time, and we'll be right back after the break. Welcome back, grade 10s. I hope you had a fabulous break and you're ready to tackle some accounting. So I just want to tell you about Curio and what's happening and how to get it, and there's awesome prizes. So what you have to do is only guess and win. And how you do is you enter Curio, so you go to q.na and you create a free account. Then you enter the Curio learn code, and then all you have to do is enter what you think or how far you think we're going to get 100,000 likes on Facebook. How awesome is that, Martin?
That sounds excellent.
We are like almost there. We just need a few more people, guys. So come on, get there and you could win some free airtime. So just get onto Curio, have a free account. It's there, and you could also win yourself some nice airtime. So let's get back to accounting though, because I know Martin's very eager to get going.
Thank you very much, Megan, and thank you, Mindsetters. So what I asked you to do during the break was to fill in the missing stars over here on our balance sheet, and I hope that you got this right. This first missing star under non-current assets, I filled it in for you in the meantime, is your fixed assets, which you should remember is your land and buildings, your vehicles, and your equipment. Also, sometimes some balance sheets say tangible assets instead of fixed assets. So if you said tangible assets over there, that's correct as well. I'm sure you got this one right. Under current assets, the missing star is trade and other receivables. We went through the notes. Inventories, remember, is going to be your note 4. Then we've got trade and other receivables, which is note 5. And we have cash and cash equivalents, which is note 6. Then under the non-current liabilities, there's usually a loan or a mortgage loan. So I'm just putting that in. It doesn't really matter whether it's a mortgage loan or a loan for this question, but we'll see how we go when we carry on. And then this little asterisk at the bottom, that can be one of two things. It can either be a short-term loan, or it can be a bank overdraft. So you remember I asked you the challenge question, where does the bank overdraft go? The bank overdraft goes as a current liability over here if you have a bank overdraft. So sometimes the bank is positive, other times it's negative. It's going to depend on the question. So I'm not going to fill in this asterisk yet because we don't know whether we're going to put in there the short-term loan or the bank overdraft. Okay, so without further ado, let's now look at the additional information that we have to put in to this question. So here's the additional information. Remember, we're doing a balance sheet, Mindsetters, and we're fixing the mistakes that the accountant has made. She didn't take certain additional information into account. So what we've got to do is we've got to read these adjustments very carefully, and we've got to put them in the correct place in the balance sheet where they're supposed to go. So let's look at the first one. The first one says a new computer costing 12,000 Rand was bought on the last day of the financial year. So what we've done is we've bought a new computer, but it says that no entry has been made. So this bookkeeper didn't take into account the fact that we have bought a new computer. What you have to realize here is that computers are usually counted as equipment. So what we have is we have equipment that has been purchased for 12,000 Rand, but basically we haven't recorded it. And because it says it was bought, we can assume that we have bought this equipment for cash. So my suggestion when you do an adjustment like this, try and identify which two accounts are affected in the adjustment, and also try and identify where in the balance sheet we're going to find them. So we know that the equipment figure has to change, and we know that equipment has to be increased by 12,000 Rand, because we purchased a computer costing 12,000 Rand and we've not yet recorded it. At the same time, our cash has to decrease by 12,000 Rand because we have purchased something, so our bank account has to go down. Now here we're testing if you know where every item in the balance sheet goes. You should know that equipment goes in the section that we had to fill in called fixed assets. So over here we've got our fixed assets, and you can see that the 2005 figure was 75,800 Rand. But that figure is excluding the 12,000 Rands worth of equipment that we've just bought. So what we should do is we should open a bracket here and put 75,800 Rand, and we have to add to that the 12,000 equipment that we have not yet recorded. We'll leave the bracket open in case there are other adjustments to equipment, but what's going to happen is we'll put the answer in here where this missing star is in 2006. Once we've finished all the adjustments that deal with equipment, remember it could be other fixed assets as well. Try and remember which ones they are. It is land and buildings, vehicles, and equipment. Those three items go into fixed assets. But right now, our only adjustment is to add 12,000 Rand to there because that's equipment that we've bought, which we haven't recorded. At the same time, though, we purchased this equipment for cash. And what we said in this additional information is that our cash has to decrease by 12,000 Rand. This is the same as saying our bank account has to be decreased by 12,000 Rand. Where do we find our bank account? Well, that's easy. We know that our bank account is part of cash and cash equivalents. So we started the year with 12,440 Rands worth of cash, and this 12,000 Rand needs to be subtracted from there because we made a purchase of equipment, and so we need to make sure that the figure that we have in the balance sheet is then correct. Make sure you understand that adjustment. It's quite an easy one to start off with, and I'm sure that most of you have got it. Okay, let's look at our next adjustment. Our next adjustment, this is the adjustment on the fixed deposit. It says, a fixed deposit worth 5,000 Rand matured on the 1st of October 2006. When it says that a fixed deposit matures, what it means is that the bank pays the money from your fixed deposits account into your bank account, and then you can use that money. Remember, the word fixed deposit means that you are leaving that money in a special account for a long period of time, usually 6 months to a year. You cannot withdraw that money during that time, and during that time it gains interest, but once the time period is over, we use this word here, matured. We say the fixed deposit has matured, we're going to get the money back, the bank is going to pay us back that money together with the interest. So it says that the fixed deposit worth 5,000 Rand matured on the 1st of October, and then it tells us that another fixed deposit amounting to 2,500 Rand is due to mature in the next financial year. So this is something that you have to understand, and this brings me back to the challenge question involving the difference between non-current assets and current assets. So let's look at our balance sheet over here. Our balance sheet has got financial assets called fixed deposits as non-current assets at the top over here. So these fixed deposits, this 15,000 Rand, that is money that we're not going to receive for a long period of time. The definition for a non-current asset is that it is not going to be received or converted into cash for a period of longer than 12 months. And current assets, on the other hand, are items that will be received or are already cash or will be converted into cash within 12 months from this date. So what we need to realize is that we had a fixed deposit of 15,000 Rand over here at the beginning of the year. And they said that out of that 15,000, they've said that 2,500 is going to mature in the next financial year. So it's not true to say that that 15,000 that we have in our balance sheet, it's not true to say that this figure of 15,000 is all financial assets as non-current assets. Out of that 15,000, there's 2,500 that we're going to receive in the coming financial year. So what we have to do is we have to move that bit from the non-current assets at the top, we've got to move to our current assets, and specifically we have to move it to cash and cash equivalents. Now this is an adjustment that you're going to see over and over and over again. What you must do is out of this 15,000, we've got to take the 2,500 that's going to mature next year. So I'm going to subtract 2,500 from my financial assets. And then I'm going to add it to my cash and cash equivalents for the coming year, because this 2,500 Rand is actually going to be received in the next financial year. So make sure you understand how to do that adjustment. You take something that is a financial asset and you convert it into a current asset, something that's going to be received within the next financial year. The other 5,000 that they speak about in this question is a bit of a red herring. It's something that we don't really need to be concerned about. It said that it matured on the 1st of October 2006. So what's actually happened, let me show you. That 5,000 Rand was previously included as cash and cash equivalents at the beginning of this financial year, because it was a fixed deposit that we were going to get paid out in the bank account. All that has happened is that we've then received the money, so it came out of our fixed deposit account and was paid into our bank account, so there actually is no change to cash and cash equivalents with that particular adjustment. But the important adjustment is that we take 2,500 Rand out of our financial assets and put it into cash and cash equivalents, because that money is going to be received within the next financial year, so we can already plan on spending it, we can already plan on using it, we can put it into our budget, and we can assume that we are going to get that money. Okay, let's look now at the next adjustment. The next adjustment is really for the second part of the question, which we're probably not going to have time to do now, but it says in order to increase sales, what the business did is it decided to offer credit facilities in 2006. All they're telling you there is that the business is not only going to sell stock for cash, they are also going to sell stock for credit. And later on in this question, if you work through the paper, they'll ask you what are the advantages and disadvantages of having such a credit policy. No adjustment to be done there, so let's move on to the next question. Now, this next question is very similar to adjustment number 2. This question says, an annual loan repayment of 10,000 Rand is made to Itopo Bank on the 1st of July 2006 each year. So once again, what they're telling us is that during our next financial year, we are going to pay 10,000 Rand of this loan. We're going to actually pay off. So we've made a contract with this bank that on the 1st of July every year, we are going to pay off 10,000 Rand. This question is testing your ability to differentiate between a non-current liability and a current liability. And exactly the same as what we did with adjustment number 2, we're going to do over here. So if you look at this balance sheet, we're going now to our non-current liabilities. And you can see there that there's a loan of 40,000 Rand. The question is telling us that 10,000 Rand of this loan is going to be repaid in the next financial year. And what you have to do when you see an adjustment like that, you're moving it from a non-current liability to a current liability. Because remember, the definition of non-current liabilities are liabilities that must be paid off in a period of greater than a year, whereas current liabilities are liabilities that are going to be paid off next year. So what we're going to do, out of this 40,000, we're going to move 10,000 from non-current liabilities to current liabilities. So the way we do that, all we're going to do is we're going to take the 40,000 in loan, which was our starting figure. You could put the name of the bank over here if you wanted to. I'm just going to save some time and space and not do that. I'm going to subtract 10,000 Rand, because out of the 40,000, 10,000 is actually a current liability. And then I'm going to create, now we know what this star is. This star is a short-term loan, or you might also see people calling it the current portion of the loan. And that is now increased by 10,000 Rand. Very, very simple adjustment. All we're doing is we're moving something from non-current liabilities, remember non-current liabilities, something I've got to pay back over a period of longer than a year. All I'm doing is moving it to current liabilities because I'm intending to pay that back this year. So that's all you need to do with that mindset is make sure you know that adjustment because it comes up over and over again. Okay, let's look at our next adjustment here. Our next adjustment gives us a ratio. It tells us that the current ratio for 2006 is 2.5 to 1. Very often, you're going to see a question that gives you a ratio somewhere in the question, meaning that you have to use the ratio to work out something that you might not be able to work out. So when you see something like this, what I strongly suggest you do is that you write down the formula for the ratio and see if it can help you in any way to calculate any missing number. So you should know that the formula for the current ratio is current assets to current liabilities. And we know that that answer for 2006 is 2,5 to 1. So we know that we've got a ratio that links current assets to current liabilities. And what you should do when you see a question like this is you should go to your balance sheet and see if there is any number or any figure that they give you. So notice, watch what they've given us. Over here, they've given us the current liabilities. There they are. They're 32,450 Rand. We know that that's the 22,450 that they've given us in trade and other payables, and we've already put this 10,000 Rand in short-term loan, so we can write that here in the final answer, 10,000 Rand in this asterisk. If you add 22 and 10, you get the 32,450. So they've given us the current liabilities. However, they have not given us the current assets at the top over here. We don't know what that is, and we've got 3 unknown numbers there, which we've got to work out with asterisks. The good news is that they've given us the ratio. So what I would suggest that we do, let's let this figure here, the current assets, let's just put an X in there, because this is the figure that we want to calculate. That's our X, that's our current assets. We can use this ratio to calculate our missing number. So let me show you here. They've told us that the current ratio is 2,5 to 1, and we've been given our current liabilities on the right-hand side over there. So let us set up an equation over here. We know that our current assets to our current liabilities are 2,5 to 1, because that's what the question gave us. We want to work out our current assets, so let's put an X in there, and we know that our current liabilities in the question are 32,450 Rand. So let's go back over here, 32,450 Rand. So we know that X as a ratio to 32,450 is equal to 2,5 to 1, because the question has given us the current ratio. Mindset is when you've got 2 ratios that are equal to each other, you can replace the ratio sign by a divided by sign. So we actually have X over 32,450 is equal to 2,5 over 1. Now it becomes very easy to solve for the X, because all we have to do is we have to multiply both sides by this 32,450. So we can set up an equation saying that X is equal to 2,5 over 1. It's not necessary to put the over 1, but I'll leave it there, times by the 32,450. And then it becomes very easy to solve for X. Let's get our calculator on the screen. X is 2,5 times by 32,450. And the answer that I get is 81125. So let's write that there, 81125. What we've done now, mindsetters, let's just recap, is we've worked out X, and X was our current assets. So we can immediately go straight back to the balance sheet and write the figure of 81125. We can write at the top where my X is. Let's erase it here. So what we've now worked out is that our current assets are 81,125. This might come in useful later when we're trying to work out one of the missing figures. Maybe we've got 2 of those 3 numbers, and we know that the 3 of them together add up to our current assets of 81125, and we can work out what the missing figure is. But Megan, I think that was quite a bit of hard work, so I think we should take a break.
I agree with you, Martin. Mindsetters, go get a glass of water, and we'll see you right after the break. Welcome back, grade 10s. Hope you had a great break and you're ready to tackle some accounting. I just want to give a nice shout out to Sethu, because he's really trying hard, and I'm super proud of him because he's like giving us actually some feedback. So Martin and I are like, Yeah. So we just want to get back to accounting, and I think Martin's going to take it away.
Thanks, Megan, and welcome back, grade 10s. What we're going to do now is just a couple more adjustments that we still have. We've got 3 more adjustments to do in this question. And the first adjustment that we've got to do is that it tells us that the bank balance increased by 2,660 Rand for the year. There were no changes to petty cash, and there were no changes to the cash float. What I hope you see by now is that when we're doing this type of adjustment, we're really dealing with our cash and cash equivalents. So what we have here is that they've told us that the bank balance increased by 2,660, and they said that there were no changes to the petty cash and there were no changes to the cash float. You should know, mindsetters, that those are the 3 items that make up cash and cash equivalents. So what they've actually told us is they've told us our closing balance for cash and cash equivalents at the end of the financial year. So if you look here at this balance sheet, we've got a calculation over here with the various changes to cash and cash equivalents. But to be honest, we don't actually need to finish the calculation, because what the question has done is the question has actually told us that the bank balance increased by 2,660 Rand. There it tells us. So what they've actually said is that our cash and cash equivalents went from 12,440 last year. They increased by 2,660 Rand, and that's going to give us the figure for cash and cash equivalents over here. So it really is very easy to calculate. All we have to do is get our calculator out, and we have to take the figure of 12,440 from last year, and if our bank balance increased and everything else stayed the same, we simply have to add 2,660 in order to get our figure for cash and cash equivalents at the end of the year. So let me just get the calculator up here. If we want the figure for cash and cash equivalents, we need to take our 12,440 Rand that we ended last year off with. There it is. And we have to add to it our 2,660, which they say our bank account increased, and that gives us the new figure of 15,100 Rand, which is supposed to go over here in our note. So let's put it in here, 15,100 Rand. That is now our new figure for cash and cash equivalents. Again, all we did is we took last year's figure of 12,440, increased it by 2,660, and that gave us the answer of 15,100. Just erasing that so we don't get confused with what those figures actually mean. Okay, our next one here tells us that the owner withdrew 12,000 Rand cash and 1,500 Rands worth of stock during the year, and it says that this was recorded. The only reason they're telling us this, mindsetters, is because they want us to check to see whether it's been recorded or not. The bookkeeper actually recorded this transaction correctly. It says that this was recorded. So we know that the 12,000 Rand cash and the 1,500 Rands worth of stock has already been accounted for. So in this particular question, we don't need to do anything with that. I'll just show you that the question had a second part, and the bottom of the second part is that we had to calculate the drawings for the year. So I'm not going to do this part of the question. I'm going to leave that for you to try, but this is our note 7. If you are taking the drawings into account, you'll need to do something with them over here to figure out the drawings. But I'm sure you know what the answer is to that. Try and figure it out yourself and compare it with a memo to this question that we will put up on our page. So that's not really relevant to the balance sheet, but it is relevant to the note to the balance sheet, which you may need later on. Okay, let's look at our next piece of additional information. Here they're telling us that the trading stock account, remember the trading stock account is a very important account. It says that it reflected a balance of 47,500 on the 28th of February 2006. So when we speak about the trading stock account, you need to know that we're speaking about our inventory. Remember our inventory note we said earlier consists of 2 important parts. It's got trading stock on one hand, and then it's got consumable stores on hand on the other. Make sure you know how to fill that in. It says that there was a balance of 47,500 Rand on the 28th of February, which is the end of the financial year. But what it says is that no account has been made for the stock count. The stock count which took place on the last day of the financial year. Megan, I don't know if this has ever happened to you. Have you ever been in a shopping mall where you wanted to go into a CD shop or a bookshop and you've seen that it's closed because of a stock take?
Yeah, that happens quite a lot, actually.
It happens quite a lot. And what they do during a stock take mindset is they actually sit and physically count how many of each CD they have, how many of each DVD, how many of each movie, how many of each everything. It's quite a long process, and it's a job that has to be done because they want to determine whether any stock has gone missing or whether any stock has gotten stolen. So what we do is at the end of the financial year, we do a physical stock take, and it says that the stock take showed that we valued our stock at 46,500 Rand. So what's actually happened here is that in our books, we've got a figure of 47,500 Rand. So let's just write that down here. Our books show 47,500 Rand. So that's the value of the stock that we think we actually should have. We think we should have 47,500 Rands worth of trading stock. What we then do is we sit and we do a physical stock take. We value all our stock, see how much there is, write everything down, and what's happened is we've seen that we actually have only 46,500 Rands worth of stock. So this is our physical stock take value. Now, this is an adjustment that comes up again and again and again. I'm sure some of you are already shouting it at the TV screen. This is a trading stock deficit. We should have 47,600, but we actually have counted only 46,500. So what that means is that there is a deficit of 47,500 minus 46,500. There is actually 1,000 Rands worth of stock that has actually gone missing. We don't know where that stock is. It's lost. It may have been stolen. It may have been damaged. Maybe an employee accidentally dropped it and wanted to cover it up and hid it somewhere or threw it away. This is an unexplained stock deficit. And what you need to realize is that when you do the adjustment, this is going to go under operating expenses in your income statement. So the difference between the stock that we counted and the stock that we have in our books, this is a deficit and should be shown as an operating expense. What we are going to do, however, is that this 46,500 Rand that we've actually counted, that is the correct value of the stock in our books, and that is the figure that we're going to show in our balance sheet. So if we go back to our balance sheet, you see here that there is an item for inventories. What we're going to do is we're going to record the 46,500 Rand, not the 47,500. 47,500 is what we think we should have, but when we've actually counted it, we've got 46,500, and that's the figure that must be recorded in the balance sheet. So remember, when you are preparing your balance sheet and doing the inventory note, you always record in there the stock that you physically counted, not the book value of your stock. Very important, make sure you know how to do that. The second part of this adjustment is that it says that we counted stationery of 250 Rand. So again, we did a physical stock take, we counted all our pens and pencils and receipt books and paper and everything that we use in the business, and we saw that it came to the value of 250 Rand. What this means, mindsetters, is that we haven't used that 250 this year, and our adjustment is that we will go to stationery, which we're going to find in the operating expenses section of the balance sheet, and operating expenses section of the income statement, not the balance sheet, and there's going to be a figure there. We don't know what it is because we're not doing an income statement here, but let's say, just for argument's sake, that it's 5,000 Rand. What we're going to do is we're going to subtract the 250 that's on hand here, because it's not true to say that we used 5,000 Rands worth of stationery. It's not true to say that we had an operating expense of 5,000 Rand for stationery, because there's 250 Rands worth of stationery that's left over that can be used for the next financial year. What's going to happen when you finish your school year this year, you're probably going to have some pens and some ink and some paper and some A4 exam pad and so on left over. You're not going to go out and buy a new exam pad if you've still got your old exam pad left over. You're going to use that again for the next financial year. In the same way, this business is going to reuse that 250 Rands worth of stationery next year. So what we're going to do is we're going to show this 250 also in our balance sheet under inventories. So we have to add this 250 to our inventories figure, and that's what's going to appear over here on the right-hand side next to our inventories for the year. So if we have to work this out, let's calculate what our missing number is. We're going to take our 46,500, that's our trading stock. We're going to add to that the 250 rands worth of stationery on hand, and that gives me the answer of 46750. The 46750 I can write immediately into the figure here where it says inventories. Now notice we've got a total at the top of 81125, and that's made up of our inventories and it's made up of our cash and cash equivalents. So what we probably want to do is we want to calculate this missing figure over here, which is our inventories. That's very easy to do because we've been given the total at the top. Remember, we worked out this yellow 81125 with that previous adjustment where we used our current assets to current liabilities ratio. So what we can do, if we want to know what the missing figure is there, we can take our total at the top, which is 81125. That's our total current assets, remember. We subtract from that our figure for inventories, which is 46,750. And we subtract from that as well our figure for cash and cash equivalents, which is 15,100 Rand. So the answer that I get there is 19,275. That means that we've been given the answer to trade and other receivables is 19, let's get that figure again, 19,275. So we can immediately write that 19,275 in here. And what has now happened is that we've got the answer to our current assets. Notice also, mindset, is that last year, our trade and other receivables, that's in 2005, last year our figure for trade and other receivables was actually 0. Why was it 0 last year and is 19,275 today? Well, the answer is very easy, because this business actually started selling on credit for the very first time. Remember, they said that to us in one of the adjustments. Okay, so what we need to do now to finish the question off, we need to close all the brackets because we've got to the end of the various adjustments. Close all the brackets off. We've got our fixed assets calculation. We've got our financial assets calculation. You should be able to calculate these two missing figures here for fixed and financial assets, and you should also be able to add them up and get a total at the top for our non-current assets. And then if you add that figure at the top to the 81125, you should be able to get your total assets at the bottom here. In the same way, you should be able to work out all of these missing figures, bearing in mind that the balance sheet has to balance because the top part is our assets section, and that has to equal the bottom part of the balance sheet, which is our equities and liabilities section. So we've done all the adjustments that have been given to us in the question. I'd like to see you try and answer those questions and see what you can come up with to try and get the missing figures in the balance sheet. It's quite easy because you just have to calculate, close all the brackets, and remember that everything balances. I'll give you one hint though. You'll be able to calculate your total assets, and once you have that figure, you need to rewrite that figure at the bottom here in total equity and liabilities. You see, we don't know in this particular question what our owner's equity is, but we know that the two parts of the balance sheet have to balance, and so that's the only missing figure. If you take your total at the bottom and subtract everything else, you should be able to find your owner's equity over there. So try that and see if you can get the balance sheet to balance. I'm sure that you'll be able to do it. Now, before we end today's show, I just want to go back to our challenge question. So our first challenge question was, explain the difference between current assets and non-current assets. Megan, did we have anybody who tried to answer that question on the internet?
We did. He was Sethu. I'm just going to read you. He said current assets mean that they last for a long time and non-current assets for a short time.
Sethu, you're on the right track, but unfortunately it's just the other way around. Okay,
Switch.
so let's just be clear about that. The current assets are the ones that are short-term. And when we say short-term, they are the ones that are less than 12 months. So these are items in the business that we're going to keep in the business for less than 12 months. In other words, they're going to be your three main things they're going to be your inventory, they're going to be your cash and cash equivalents, and they're going to be your debtors, which are called trade and other receivables. You're hoping to sell your inventory within that period of time. You're hoping to receive the money from the debtors within 12 months, and the cash is already cash. Non-current assets are the long-term ones. And the answer to the second part of the question is exactly the same, the current liabilities versus non-current liabilities. Once again, the current liabilities are the short-term ones. They are liabilities that you have to pay off within the very near future. within 12 months, whereas the non-current liabilities are the long-term ones. These are typically loans that you've got over a year to pay off. So please be careful that you don't confuse the two, because you could lose a lot of marks in the exam if you mix them up. It's easy to mix them up. Please don't do it. Okay, then we asked what items had to go in Note 7, and I asked you to reconstruct it in the space below. Remember, your Note 7 is your owner's equity note. What we really have here is we have the owner's equity, I'm just going to abbreviate it, at the beginning of the year, which is really your capital. And what we're going to do with that is we're going to add to that plus your net profit for the year. Sometimes different textbooks have got different ways of showing these answers, but net profit will be the second item on the list. We're then also going to add any additional capital that was contributed by the owner. So if the owner increased his or her capital contributions, we'll put additional capital over there. Then what we're going to do is we're going to subtract the drawings for the year, and what's going to happen is the final answer is going to be our owner's equity at the end of the year. Please also be sure that when you do this, the drawings need to be shown in brackets on the right-hand side. And then the final question that we had, where would bank go if it were an overdraft? Well, I've said the answer already. That's going to go in trade and other payables, because you owe the bank the money, you're in overdraft, you have a negative bank balance. Well, Megan, I think that's it for today.
That's it for today, Martin. Are you ready to say goodbye?
Yes, mindset is good luck with your exams. Keep trying, keep adjusting, and I hope that you have good exams.
Awesome, Martin. Thank you very much. Thank you, Grade 10s. Thank you for tuning in. I just want to say thank you to the MTN SA Foundation for sponsoring the show, and the show is endorsed by the Department of Basic Education. Have a great afternoon, and we'll see you again soon. Good luck. Bye.